Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our second quarter market review and outlook report. In our first quarter report entitled, Moving the Goalposts, When Will It Stop?, we highlighted that after one of the most intense interest rate hiking campaigns in history, the Federal Reserve was likely nearing an end to the increases, and that action would remove a material headwind on the economy. We also indicated that while stock valuations were certainly not cheap in April, declining inflation data should lead to lower interest rates over time, which in turn should likely lead to expanding price earnings multiples and higher stock prices. While interest rates did not decline in the second quarter, inflation data did improve and stock prices rallied sharply. Additionally, we pointed out that while earnings estimates have steadily declined this year, the projections for next year remain robust for both domestic and international stocks. After the Fed raised the federal funds rate for the 10th consecutive time in early May to a level of 5 to 5.25%, they chose not to raise rates at the June meeting as the committee indicated their desire to assess the economic impact of previous increases. Annual headline inflation, as shown in the Consumer Price Index, dropped to 4% in May, the 11th straight month of decline and the lowest since March of 2021. As we've stated in our previous reports, many inflation indicators such as the Global Supply Chain Pressure Index, inflation expectation surveys, and commodity prices peaked last year and are headed lower, giving the Federal Reserve fewer compelling reasons to raise short-term interest rates from this point. The S&P 500, led by gains in select large technology-related companies, enjoyed a strong second quarter. The vast majority of the gains in the index were driven by the robust performance of 7 companies, affectionately called the Magnificent Seven. These top performers were well-known names: Apple, Amazon, Microsoft, NVIDIA, Meta, Tesla, and Alphabet. Investors piled into these stocks as they were perceived as safe havens from the uncertainty of overall corporate earnings. In addition, the stock market was helped by the resolution of the debt ceiling debate, which removed a significant hurdle for economic growth and stability. As we look at the overall economy, while manufacturing is still in contraction, services remain the backbone of the current economic growth as consumers are vacationing and eating out. Unemployment continues to be low and is still supportive of consumer spending on services. Despite rising credit card usage, total consumer debt is still reasonable as a percentage of disposable personal income, and wage growth of 5% now exceeds headline inflation. That said, the Fed's policymakers indicated that they envision potentially 2 more interest rate hikes this year, a more hawkish forecast than had been expected. And even after the Fed has stopped hiking, it's likely to keep borrowing rates at a peak for months to come. As a result, consumers will still have to bear the weight of higher cost auto loans, mortgages, credit cards, and other forms of borrowing. And the stock market's gains this year do present some near-term valuation headwinds for U.S. stocks. And we believe the third quarter performance may be a bit choppy. Should the analysts' earnings projections be lowered due to more evidence of downward economic pressure because of additional banking concerns and rising unemployment, the stock market may give back some of 2023's impressive gains. However, over the next year, stocks will likely continue to outperform bonds as inflation continues to subside, the Federal Reserve stops raising interest rates, and the stock market anticipates an earnings recovery in 2024. A declining U.S. dollar coinciding with peaking interest rates should benefit international stocks, which have been previously hurt by a strong dollar. In sum, we feel that inflation pressures will continue to ease this year, interest rates will likely peak soon, and the economy will avoid a significant recession as consumer spending is bolstered by low unemployment and strong wage growth. On a final and important note, history shows that stocks usually perform very well beginning shortly after a Fed hiking cycle concludes. Thank you for watching today, and please read our full market review and outlook report for greater detail on the second quarter and our forecast for the rest of 2023. Take care, and we'll see you next time.